Hello and welcome. I am Brian Copeland, the Director of Financial Planning at Hightower Wealth Advisors, St. Louis. With our varied skills, resources, and experience, our ensemble of wealth advisors help you make a plan, make an investment, make a difference. So today we welcome Katie Haug with Caravus to spend about the next 30 minutes discussing things really all related to Medicare. Katie started working in the health insurance industry in 2005 when she joined Caravus, and she leads a team specializing in individual and employer-sponsored health insurance plans. A love of working with and helping others fuels her drive to offer clients solutions to be prepared for their future health needs, all while navigating the ever-evolving health insurance landscape. Many of you probably recognize Katie, as she did an event with us last year around this time. Now, 2020 has definitely thrown us all a curveball, and it's keeping us from having any events in person. So we hope you find this webinar version just as helpful, and feel free to pass it along to any family and friends. Since you aren't here in person to ask questions, please follow up with any specific needs that you have. We will have our contact information displayed at the end of the discussion. And I think with that, I will turn things over here to Katie.
Perfect. Thank you, Brian. Thanks for the intro. All righty. Let's see here. So yes, thank you. Thank you again for the intro. Kind of jump right in here with regard to my presentation today. So clearly talking about Medicare today. And I guess I will also start by saying also that my contact information will be in the tail end of this presentation. So if I don't address one of your questions during this call, please feel free to reach out to me directly and ask those questions, either give me a call or email me. I'm happy to speak with you and work with you one-on-one if it's not something that I can address during the presentation. So, all righty, so let's go ahead and jump in. So discussion this afternoon, again, surrounding Medicare. So I'll kind of start on industry statistics and give you kind of a sampling of where Americans are getting their health coverage today. I'll get into the Medicare market overview. So all of those different letters that are thrown around, definitely go through those. Market changes. So if anybody is in the Medicare space today or has read about recent changes this year, I'll go through some of those, as well as enrollment periods and any penalties associated with the enrollment periods if someone does not enroll within the specific time frame. Questions, again, definitely reach out to me, one-on-one after you view this presentation. So industry specifics today, again, focusing on really two segments here, Medicare Advantage and Medicare, Original Medicare, which is that single payer system. However, you can see from this pie chart here, most Americans today are getting their coverage through employer-sponsored health plans. So those are the group coverage that you have if you're still actively working and have an employer-sponsored plan. That's clearly where most individuals, are getting their health coverage today. So we'll be focusing on these two little slivers here in today's presentation. So Medicare was first introduced in 65, and that was for individuals that were over age 65. And that was expanded in 72 to individuals that were under age 65 and qualified for Medicare disability. And someone qualifies for Medicare after they have been deemed disabled by Social Security for 24 months. And so that's after that 24-month mark, that's when somebody under age 65 would qualify for Medicare. Now, this slide here, super important on this slide, a lot of words on this page, but this will help, I think, a lot of you listening to this presentation to determine whether or not you need to do something when you turn 65 if you're still working for an employer and have coverage through that employer. And so over on the right-hand side here, this first question, are you on Medicare and over age 65? And if you answer yes to that question, the next question becomes, what the size of your employer is. And if you're participating in an employer plan over the age of 65, so anybody that is still working over age 65 for a small employer, let's say it has 15 employees. In that scenario, less than 20, Medicare is primary and the group plan is secondary. In this scenario, that individual, because Medicare is the primary payer, in that scenario, that individual definitely wants to enroll in Medicare. Again, under 20 wants to enroll in Medicare. If that employee count threshold is over 20, this situation reverses and Medicare becomes the secondary payer and the group plan becomes primary. And in this case, when the group plan is the primary payer and Medicare secondary, there really is no incentive for that individual to enroll in Medicare when first eligible. The other scenario are those that under 65 population that are on Medicare disability. And the only difference here is that this employee count, this threshold increases to 100. So less than 100, Medicare's primary. Again, that person wants to enroll. Whenever Medicare is primary, you want to enroll in Medicare. But if it's more than 100, again, that situation reverses. Group plan's primary, Medicare secondary. Again, no need or incentive to enroll.
A quick question, I think with that, Katie, it's something that we hear fairly often. I'm sure you do as well. So you went through those scenarios when those should enroll for Medicare, just because the number of employees is below. For those that are over that don't need to enroll, is there anything they actually need to do at 65? We always hear about a potential penalty if they don't do something. What happens in that scenario if they're not planning to enroll? Is there anything else they need to do?
No, and there is a lot of common confusion surrounding that, and people, read things, hear things, and think that they absolutely have to do something at age 65, and that's actually not the case. So in this scenario, again, more than 20 employees, if that person's still actively working, or the spouse, maybe, it's a husband and wife, and the wife is still working, but the husband is not. If that husband is covered by that, that wife's plan, totally fine, as long as you've got coverage based on what's considered current employment. And what that means is just you're actively working and earning a paycheck. So if someone is still actively working, they literally do not need to do anything at 65. They don't have to enroll in A, they don't have to enroll in B. When they retire in the future, they're able to pick up A and B without any penalty.
Okay, great, thank you.
So this slide here, and I'm not going to get into a ton of detail here, but I think this is at least helpful to kind of compartmentalize each of these letters. So part A is hospitalization. Part B is physician services. And these two parts on that last slide where I was talking about, you don't have to enroll in Medicare, what I'm talking about is these two parts. That is what's called original Medicare. And you don't have a choice there. Those are government provided benefits, A and B. So A, again, hospitalization. So really any inpatient care falls under Part A. Under Part B, any outpatient care falls under Part B. There's no premium associated with Part A if someone's paid into Medicare taxes. There is a premium associated with Part B, which I'll talk about in the next couple of slides. It's income dependent, and you'll see some different income thresholds with respect to Part B. Medicare Part C is what's called Medicare Advantage plans. And again, I'll get into a little bit more detail with regard to Part C in a moment. Medicare Part D is what is called drug coverage or Medicare prescription drug coverage. And then we've got MEDIGAP or Medicare supplement plans. So these two terms interchangeable.
Another question that kind of pops up here, it kind of ties into the last slide too, but just signing up for Medicare in general, is it automatic, or are there times where it's automatic versus someone having to do something?
Yeah, great question. So it is automatic only for individuals that are drawing Social Security. So if someone is drawing Social Security, let's say they started at 64 and then they turned 65, they are automatically enrolled in Medicare if they were drawing Social Security. If they're not, so if it's a 67-year-old and maybe they're waiting until age 70 to draw Social Security, that is perfectly fine. They are not automatically enrolled. And if they are retiring, say at 67, we would need to actively enroll them in Medicare A and B, which is done through Social Security. That's who processes the Medicare application. So it can get a little confusing because it is the same entity, but Social Security processes the Medicare applications. But it really, when you apply for Medicare, it really has nothing to do with applying for your Social Security benefits. And so on the next couple of slides, what we'll look at are the Part B and Part D, IRMA. So many of you may have heard the acronym IRMA, which I'll explain that in a little bit more detail, but that is what this particular slide is speaking to. So a couple of comments here. In 2020, the Medicare Part B and the Part D premiums are based on 2018 tax return. So if you're filing taxes as a married couple, in 2018, if your income was less than $174,000, and that is your modified adjusted gross income. So if you're less than $174,000, you're just responsible for the standard premium of $144.60. But let's say you're down here. Let's say you're between $326 and $750. You would pay the standard premium of $144.60 plus an additional $318.10, which totals a monthly premium of $462.70. And that would be per person per month. So if both husband and wife are applying, it is again per person per month. With respect to the drug coverage, so this is that Part D IRMA. And IRMA stands for Income Related Monthly Adjustment Amount. And so this $70 here is what is considered Part D IRMA. And in this scenario, the way this works is you would enroll in a drug plan, or should want to enroll in a drug plan. So you'd pay a premium to the insurance carrier. So let's say it's United Healthcare. So United Healthcare is collecting the premium for the plan. And then the government or Social Security is collecting an additional $70, which is Part D IRMA. And that's because you would be in this particular income bracket. On the next page here, and I'm just showing you here if you file taxes as an individual versus a married couple. What you'll notice is the amounts are the same, but because you're filing as an individual, your income thresholds are going to be a little bit different here.
So one question with this, and it's something we come across a lot just with helping with retirement. Is there a way to appeal this? Because if they look at your income from a couple years back and you happen to retire, there's a chance that your income is lower today than it was 2 years ago. Is there a way to appeal that to pay less currently, or do you have to wait 2 years until the tax return shows your income went down?
Yeah, and that's a great question, very common question. And the answer is absolutely you can appeal. And so work stoppage or work reduction is definitely a qualifying event to appeal for a lower premium. And so if you have retired and your income has changed from, the 2018 tax return that they're referencing to the time that you enroll, you can appeal. You would do that directly with Social Security. There is a form that has to be completed. And I believe they may ask for like supporting documentation, and basically you need to, explain to them what your income, would be in the future, and then they'll determine whether or not that they would, accept that appeal for a lower premium. But just in general, the premiums do change every year as well. So, clearly this is in 2020, it's 2018, but in 2021, it will change to reflect your 2019 income. So that does change automatically. So it's not something that, an individual would need to contact Social Security for unless they were going to appeal it. It's just an automatic process that they'll, again, pull that most recent tax return and make those adjustments. So on this particular slide, talking about the items or the services that are not covered by original Medicare, which is Medicare A and B, which because Medicare A and B doesn't cover everything, there is a necessity to kind of tack on additional coverage, which we'll see on the next slide. Just a sampling of items or services that Medicare doesn't pay for, prescription drug coverage, Medicare doesn't pay for that. There are deductibles and there's co-insurance that Medicare doesn't pay for, vision, hearing aids. So again, just kind of a sampling of the different parts that Medicare doesn't pay for. And on this particular slide, really two main options for an individual when they're transitioning into the Medicare market. So after they've retired, they're coming off of their employer plan, they really have two choices here. Option number one would be to enroll in original Medicare A and B, enroll in a Part D plan, which is prescription drug coverage, and then enroll in a supplement policy, also commonly referred to as MEDIGAP. The alternative would be to enroll in Medicare Part C, which is commonly referred to as Medicare Advantage. And in this situation, everything is combined. It's covered, it's provided by a private insurance carrier. And it's really a managed care type of a plan. But in both scenarios, whether you go option number one or option number two, you're still enrolling in Medicare A and B.
One question. So if someone went with option one there on that slide, and let's say, for example, they didn't or weren't taking any medications, do they still need to sign up for Part D, or is that part optional under that option one?
Yeah, a great question. So with respect to Medicare Part D, I would definitely suggest that an individual enroll in a drug plan. If they're taking very little maintenance medications, maybe they're generic and they're inexpensive, or maybe they're not taking anything at all, I would definitely suggest enrolling in one of the lower cost options, because if you don't enroll when you're first eligible, you are charged a penalty in the future. And I'll speak a little bit to that penalty in future slides so that you can see what that penalty would look like if somebody doesn't enroll in a drug plan, when they're first eligible. And also to give you a little bit of landscape with regard to the drug plans and premiums. So I mentioned enrolling in one of the lower cost plans. The plans range anywhere from like $13 a month, and they can be as high as about $90. So you do have that widespread in terms of premiums, especially if you're not taking really any medications. You'd probably go with one of those lower cost options to avoid that penalty. And major differences between the two routes, Medicare Supplement and Medicare Advantage. So on the Medicare Supplement side, your premiums are going to be a little bit higher compared to Medicare Advantage. However, with that higher monthly premium, you do have the freedom to choose any doctor, any hospital you choose to go to, nationwide, and no referrals are necessary on those plans. Again, the alternative would be to enroll in what is called a Medicare Advantage plan. And in that scenario, your premiums are going to be lower, but then you do have co-pays and cost share that you'd be responsible for throughout the year for your services. And those little copay amounts will all accumulate toward an out-of-pocket maximum, roughly about $3,500 to $4,000 annually. And with those Medicare Advantage plans, I mentioned, I think on the last slide, that those are managed care type of plans. So really the insurance carrier is setting that network of doctors and hospitals for that individual. Emergency services on those plans are only covered out of service area. So if you're traveling, you're only going to receive care in the case of an emergency. So on those Medicare Advantage plans, again, they just don't give you the flexibility that you would experience on a Medicare supplement plan where, you know, again, you can go to any doctor, any hospital you choose to go to. On the next several slides, I've got examples of premium associated with whether you go with a Medicare supplement or a Medicare Advantage plan. And so on this particular slide, this is an example of a Medicare supplement and prescription drug plan. And in this scenario, I am assuming that it is a married couple whose income is between $326 and $750. And you can see the individual filing as well and the different thresholds there. But in this case, Medicare Part B premium $460 to $70. The Part D IRMA, it's $70. I kind of threw in an average drug plan premium of about $30. Again, I mentioned it ranges from like $13 to $90. And then I put in a Medicare supplement plan option average of about $175. So in this scenario, this totals $737 a month per person, or about $88.50 a year. And that $175 premium on a Medicare supplement plan, or MEDIGAP, that is representative of a Medicare supplement plan G. And with a Medicare supplement plan G, and this is what most people are taking today, or enrolling in today, in this scenario, the member would be responsible for the Part B deductible, and that's an annual amount of $198. So in this scenario, on this page here, that individual has very little to no out-of-pocket expenses for hospitalization and physician services. They're only responsible here for this $198 deductible. On this next slide, these premiums are representative of a Medicare Advantage plan. And what I've pulled in here would be an example of an HMO. And on an HMO plan, that is called, or the HMO, the acronym stands for Health Maintenance Organization. And that is when referrals are required to see specialists. So it's a pretty narrow network, and then you'd have to get referrals to see specialists. And on that plan, in this scenario, you're still paying the Part A, well, I'm sorry, there's no premium for Part A. You're still paying your Part B premium, which is dependent on your income. And so again, just for simplicity purposes, I took that same income bracket, $326 to $750. So your Part B premium at $460 to $70. The Part D IRMA of $70. And then $0 premium on that Medicare Advantage plan. And again, with that Medicare Advantage plan, your premium is lower, but then you are restricted to a pretty narrow network of doctors and hospitals. Again, on an HMO, referrals are necessary. And you're paying co-pays and co-insurance for your services, which all accumulate toward that kind of like $3,500 to $4,000 out-of-pocket max. So a couple of things that, again, if you've been in the Medicare market, or if you're in the Medicare market today, or heard people talk about it, or did any reading, there's been a change this year that a lot of people are talking about, and that's with respect to Medicare Supplement Plan F. And that did go away to anyone new to Medicare, turning 65 on or after January 1st of 2020. If somebody was in Plan F prior to that date, or if they were eligible for Medicare prior to that date. So as an example, if you're just now retiring at age 67 and you're going into the Medicare market, you would still have access to Plan F because you were eligible for Medicare prior to that date, even if you didn't enroll. Plan F was the highest level of coverage that someone could purchase. And again, that's no longer available. So most individuals, as I mentioned on the last couple of slides, most individuals are choosing that Medicare Supplement Plan G today. And really, I'm going to back up for a second just so you can see the comparison here. So Plan F, the only difference between those two plans is that Plan F covered the Medicare Part B deductible, whereas Plan G does not cover that. And again, that's an annual amount of $198. And that is the only difference between those two plans. With the discontinuation or no longer offering Plan F, that also meant that the high deductible Plan F went away. The high deductible Plan F had a deductible of $2,340. So when Plan F went away, high deductible Plan F went away, and then they introduced this high deductible Plan G. Also, what happened this year in 2020 was the donut hole closing. And closing, not really the best word to use because it's not going away altogether. When someone hits the coverage gap or the donut hole with respect to their Medicare prescription drug plan, it used to be that they paid 100% of the cost of their medications. And now when they hit the coverage gap, they're responsible for only 25% of the cost of their medications. And so that 100% over the years has slightly decreased. And again, that's where it is today at 25% is the lowest that it's projected to be. And so, the language closing is because that's, the lowest that it is projected to be. And then Plan G also, because Plan F went away, there are certain guaranteed issue scenarios that Plan F had, where those guaranteed issue scenarios are now moving to Plan G. And it gets pretty specific, so I don't want to get into too much detail, but what I mean by guaranteed issue is simply that you don't have to answer health questions. So historically on a Plan G, you would have had to answer health questions to enter into that Plan G and medically qualify. Whereas a Plan F, you may not have had to answer those questions. So all of those rules that were attached to Plan F have now moved to Plan G. And again, it gets really specific. So, certainly based on, your specific situation, I can walk you through all of those little nuances, and let you know which policies would be available to you and if underwriting would be required.
So quick question on that, Katie. So with Plan F going away, even though it sounds very similar to Plan G, if someone has a Plan F, they can still continue to keep it. Is that correct?
Yes, that is absolutely correct. So they will always be able to continue that Plan F if they were eligible for that. And so yes, it cannot be taken away from them as long as they continue to pay their premiums. Yeah.
But if they switch to Plan G, then there's no going back?
Actually, they could. So really, just this date here. So anybody that was eligible again prior to that date would always have access to Plan F. But in that scenario, if someone moved from F to G, they'd have to medically qualify to do that. So they'd have to answer health questions. Okay. And then if they wanted to go back G to F, again, they'd have to answer those health questions.
Okay.
So the next section here are the enrollment periods. So I'm going to go through really 3 different sets of enrollment periods. Okay, so on this particular slide here, talking regarding the Medicare Part A and B, so that's original Medicare, the enrollment periods there. The initial enrollment period lasts 7 months. So it's 3 months prior to someone's 65th birthday, the month of their 65th birthday, and 3 months after. If someone doesn't enroll in this initial enrollment period, they do have this special enrollment period that they would be eligible for. And the special enrollment period lasts 8 months from their employment ending. If they don't enroll here, and also don't enroll here, they'd be eligible to enroll during the general enrollment period, which is January through March 31st, and then their coverage would begin on July 1st. Couple of comments here. In this small footnote here, COBRA and retiree coverage is not coverage based on current employment. And this does get a little bit tricky. And I've seen this before where maybe you're a business owner and you've sold your business, and in the agreement, the new company has agreed to pay for your COBRA coverage, let's say for 18 months. In that scenario, that is totally fine to take COBRA and take that, offering for them to cover your COBRA benefits, but you definitely do need to enroll in Medicare A and B within this 8-month period of your employment ending. Otherwise, you're going to be thrown into this general enrollment period, and then you'd be paying penalties for not enrolling in this special enrollment period. So really important to keep in mind.
So if someone's going to be, right, that they're retiring after 65, rather than waiting until the 8 months after separation, when's a good time for them to start looking at that special enrollment period?
Yeah, great question. So I would say about 2 to 3 months in advance of retirement is when someone would want to start, exploring those options and, reaching out to, explore those options and start that enrollment process. Next slide, you'll see the same 7-month enrollment period. Again, it's the initial enrollment period, and that is Medicare Part C and Medicare Part D. So Medicare Advantage and Medicare prescription drug plans. Outside of this 7-month window, an individual can enroll in the annual enrollment period. And that's actually what we're coming up against in the next several weeks. Time frame is October 15th through December 7th. And if someone does either apply during that time frame, or maybe they're on a drug plan this year and change to a new drug plan in 2021, that new plan would take place on January 1st. And this does happen every year, this annual enrollment period, to be able to, review and evaluate your drug coverage and Advantage if someone was on a Medicare Advantage. There's also a special enrollment period with regard to C and D, and this is a little bit different from that 8-month window. This is actually only 2 months from losing coverage. So these enrollment periods get pretty specific, to someone's situation. So please feel free, to reach out to me or anyone, in this space to be able to assist you through, these different scenarios.
Okay, so it sounds like that the open enrollment periods, then it's not only potentially new signing up, but that's also the time to kind of change what current policies that you have?
Yes, absolutely, with regard to Medicare prescription drug plans. And we definitely encourage clients, and actually you'll see on this next page how impactful this can be, to review drug coverage during this time frame. The Medicare supplement side, however, does not fall into this same annual enrollment period. And I'll speak a little bit more to that, but this annual enrollment period, again, only applies to Part C and Part D. On this next slide here, giving you kind of a sampling of what potential savings someone could experience year to year on their prescription drug coverage. So in the first example, and this is a little extreme, although this is not, totally out of the question. This medication here that I'm showing, it's a specialty medication, so it's a super expensive medication. This is an example of the current plan. So let's say this is a 2020 plan, doesn't cover that medication. So let's say currently the plan that the individual is on, it doesn't cover that medication. So that individual is experiencing about $72,000 out of pocket because the drug is not covered by the plan. And then let's say we're evaluating plans for 2021, and there is a plan that does cover the medication. And so it is covered as a tier 5, and then it's showing, you know, the cost difference. And again, this is just, I mean, this is a great example of how important that annual enrollment period is to be able to review the drug plans, because they do change. The formularies change, the copays change, the deductible can change. So super important to kind of do this comparison of the current plan versus most cost effective for that following year. The next two examples are a little bit more common and in the difference that you can see in cost. So this one is about $700 difference in cost annually, and these are annual numbers based on a January enrollment, so looking at a full 12 months, whereas this is about $1,000 difference. So again, just super important during that annual enrollment period to go ahead and take a look and review your drug coverage. So I mentioned we would, or I would speak a little bit to the penalties associated with not enrolling on time. So the enrollment periods I just went through, if you miss those enrollment periods for, you know, any particular reason, there's really penalties associated with each of those parts. So the first one is with regard to Medicare Part A. And I will say, I don't see this very often. I think I've only seen it literally like 2 or 3 times. But this only applies to individuals that do not qualify for premium-free Part A. And so that means if they haven't paid into Medicare taxes while working, or if they don't qualify based on a spouse having paid in, that's when this penalty would apply. And the penalty, it's 10% of the monthly premium for Part A. And this year, the monthly premium for Part A is $458. And so it would be 10% of that, and then that's the penalty that person would pay for Part A. And again, it only applies if they do not qualify for premium-free Part A. In Medicare Part B, the penalty for Part B is also 10% of the monthly premium for Part B. And then the calculation is however many full 12-month periods you go without coverage. So if you go without coverage, or if you go without Part B for 18 months, they're only counting the first 12. So it's full 12-month period. So in this case, it's 2 years delay, which literally means 24 months. And so the premium penalty here is $28.92 in this example. And then that penalty is added to the monthly premium for as long as that individual is enrolled in Medicare Part B. So it's not just a one-time amount that they would pay. It is tacked on monthly for as long as they have Medicare Part B. And just to give you an example of when this comes into play and where I've seen this, I gave you that example on an earlier slide of, you know, an individual selling their business, and maybe in that sale, the company agreed to pay for COBRA coverage, and maybe they went beyond that 8-month window, that special enrollment window that was an 8-month period from their employment ending. And so maybe they took that COBRA opportunity because the company was paying for it, and they took COBRA for 18 months, and they didn't enroll in Medicare A and B because they had COBRA. In that scenario, they're outside of that 8-month special enrollment period, and so then they're charged that penalty, the Part B penalty for the number of months, that full 12-month period that they went without coverage. And this one I see most often on the Medicare prescription drug side, so Medicare Part D. And the penalty is not a lot, and you can see that from here. So the penalty is only 1% of the national base premium. So the national base premium this year in 2020 is $32.74. So it's 1% of that times however many months you delay your Part D enrollment. or if you don't have credible coverage. Because if you have coverage through an employer, chances are that drug coverage is credible, which means that it's as good as the Medicare prescription drug plan. And so if you have coverage through an employer, you know, this penalty wouldn't apply when you move into the Medicare space. This would only apply if you voluntarily don't enroll in a plan. So one of the questions that was asked earlier from Brian was, what if I don't enroll in a drug plan? Or what if, you know, do I have to enroll? And my response was, you don't have to, but if you don't, you're charged a penalty. And this is the penalty here. So as I mentioned earlier, I definitely recommend enrolling in one of the lower cost drug plans, like that $13, $14 plan, to just avoid this penalty in the future. Because once this penalty is calculated, it is again monthly. So in this scenario, you know, if you go without for a little over 2 years, you're paying a penalty of $8.51 again per month for as long as you have that drug plan. So it never goes away. And then just a little detail on the supplement side. So there is an enrollment period, an open enrollment period on the Medicare supplement side. It lasts 6 months from the time that someone enrolls in Medicare Part B and they're 65. Outside of this 6-month period, there are certain special enrollment periods. And really, it depends on the state that you live in and the carrier that you're applying with. So it gets really, really, really detailed. Again, happy to walk through your specific scenario with you so that, you know, I can explain what options are available. And what I mean by these enrollment periods and why they're important is if you're applying during either an open enrollment period or a special enrollment period or guaranteed issue period, you're not answering health questions. And the policies, again, are guaranteed issue, meaning they cannot decline you or they cannot approve you and increase your rates based on pre-existing conditions. So if you don't qualify for a special enrollment period, or if you're not applying for Medicare supplement in your open enrollment period, you can apply at any time throughout the year. The only catch is you'd have to answer medical questions and be approved to make that change. And so again, the carriers can decline or they may approve you, but increase your rates based on those pre-existing conditions. And then I'll speak a little specific to Missouri. And this is, again, state specific. In Missouri, we do have the anniversary rule or law, which allows individuals the month before or the month of their anniversary to change carriers. They'd have to stay within the same plan letter. So for example, if they enrolled in a Plan G to begin, they could go Plan G to Plan G with a different insurance carrier. The reason they'd want to do that is if the rates changed. So maybe they're with Anthem today, and then let's say Aetna is more competitive that next year and they can save, you know, $20 or $30. They would be able to move to Aetna the month before or the month of their anniversary without having to answer any health questions. And again, that's specific to Missouri. If that same person lived in Illinois, if they wanted to make a change from, you know, Anthem to Aetna, they'd have to medically qualify to make that change.
So one, I guess, kind of wrapping up question here, because I think you're getting close to finishing up most of the content. And it's really just around, does everyone accept Medicare? What happens when a doctor doesn't accept Medicare?
Oh, great question. So not every physician accepts Medicare. And so if you are in a situation where your physician doesn't accept Medicare, then you would pay out of pocket to continue seeing and pay out of pocket for those services with that particular physician. It's really rare for a physician to not take Medicare. I would say less than 1 to 2% nationwide don't take Medicare. Typically the professions that I see that don't take Medicare, a lot of chiropractors, and then concierge physicians. So, you know, physicians that have moved toward the fee-based model, and typically they're not submitting, you know, claims to any insurance carrier, and they're in that, you know, concierge or fee-based model. But yeah, pretty rare, but they are out there.
Okay.
And just a little bit about how we could help if you were looking for assistance in this market as you transition from, you know, retirement and transition into retirement and needing assistance in the Medicare space. Just a little bit about our process. So here, just really 2 main documents that we would require or ask to be completed in advance of putting together some specific material. So the first form here, this Medicare eligible quote form, this is basically just asking for demographics. I will ask for a list of medications so that we can shop the different drug plans available to you. And then with that information, we'll again shop the various carriers. So we are a broker, so we're gonna really give you the full, you know, full spread of all the major competitive carriers in your area based on your needs. And then this is simply a compliance form, the scope of appointment form that CMS, so the Centers of Medicare and Medicaid Services, require agents or brokers to have on file so that we're not soliciting business. And this just basically allows us to be able to talk about, you know, the various plans with you. And this just giving you kind of a sampling of what the output looks like. So this is after we've processed those quote forms and again shopped the market, and we'll put together a specific proposal for, you know, each individual or couple and really walk them through the process of applying for Medicare and then subsequently the supplement and the drug plan. At this time during COVID, these meetings are all virtual, although historically, and especially if you are in, you know, the St. Louis area, our office is located in Clayton, and so have definitely done face-to-face meetings previously. So as soon as we're back in the office, I'm happy to do that. But until then, we'll be talking through this screen. But this is, you know, again, a sampling of what that presentation looks like once we've put together material for the client. And this is just, you know, going through different drug plan details, understanding what the co-pays would look like for an individual based on, you know, specific medications and pharmacy. So pharmacy is actually really important when you're looking at these drug plans because there's about 30, I think I said that previously, there's about 30 available per state. And they pretty much all have different relationships with pharmacies. And they change year to year too. So this year, actually, CVS has majority of the preferred relationships where in the past it's been Walgreens. So it's kind of this revolving door. So pharmacy is super important as you're evaluating drug plans. And I think that is it. I don't know, Brian, if you had any other questions that you could think of on the top of your head or just things that clients always ask about?
No, I think we kind of mixed those in during, so I don't have anything else on my list here. So again, thank you. This was wonderful. We do appreciate you sharing your time and guidance, but there's definitely nothing easy about making Medicare decisions, and it's never final either. Almost have to look at this stuff every year. So once again, our contact information will be displayed here shortly. If you have any specific questions, don't hesitate to reach out. Thank you for joining us. Again, I am Brian Copeland with Hightower Wealth Advisors St. Louis, where we help you make a plan, make an investment, make a difference. So now let's go out and make a difference. Thanks.